Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, November 16th, 2022. So we got the October retail sales data, and let me guess, you take a guess at how good this stuff was. It was fantastic. It's everything we've been pounding the table on with respect to the resiliency of the US economy since late July. So, just unpacking the numbers, looking at headline retail sales, which are reported on an inflation unadjusted basis, they accelerated 690 basis points to 7.9% on a 3 month annualized rate of change basis. That's the fastest rate we've seen since June of last year, and the fastest increase in terms of the rate of change, that 690 basis point acceleration, since March. If you look at retail sales control group, core retail sales, which feeds directly into GDP, it's about a quarter of overall consumer spending. Retail sales, core retail sales accelerated to 120 basis points to 7% on a 3 month annualized basis. That's the fastest rate we've seen since August, and the biggest increase, the biggest acceleration we've seen since June, and that was being largely driven by an acceleration in auto sales. We saw a 3,140 basis point acceleration in the 3 month annualized growth rate in auto sales to 46.4%. That compares to a 10-year moving average 3 month annualized growth rate of auto sales of 2%. This U.S. economy continues to grow well above trend. I know we're headed for recession. The 3 month 10-year yield curve, as it told you that, the spread between the present situation, the spread between the expectations and present situation in the Conference Board data are telling you that. The spread between the labor differential survey are telling you that. A variety of indicators are telling you that. Leading indicators for PMIs, some of the different market indicators. We know we're headed for recession. It's about the timing with which the recession happens as it relates to the market movements, the developments in asset markets, in terms of how they're going to impact your portfolio. If we get a recession in the very near term, then you buy bonds, sell stocks, and it's deflation playbook. It's pretty easy. If you get a recession a year from now, then I think the context of what you need to do from a risk management perspective is a lot more murky, and that's what we tried to address in great detail in our November 22 macro scouting report presentation that we put out last Tuesday. So if you haven't had a chance to review that, I highly, highly encourage you to review that. I highly, highly, highly encourage you to review today's leadoff morning note. We unpacked the massive increase in net liquidity that we've seen month to date and quarter to date. And then we talked about some of the dynamics that we see coming down the pike that may either perpetuate that or cause that to reverse. We're not going to give any clues here because, again, that is the copyrighted material of 42 macro subscribers who pay for our team to bust their ass every single day to boost that research. And we're grateful for them. We're grateful for you for tuning in to this free program, by the way. Don't forget, we're busting our ass to produce free content as well. So we want you to appreciate that because we appreciate you for tuning in. And we certainly appreciate all of our subscribers at 42 macro. So anyway, getting into my longboard dashboard here, just starting with global macro. Same setup as yesterday in terms of all the main indicators that we're looking to give us clues on the next direction of the market are more or less in the middle of the probable ranges. Dollar still short-term, dollar still bearish from a short-term and medium-term price momentum basis. It's getting towards the lower boundary of the range, but not quite getting there yet. It's starting to lose a little bit of momentum to the downside, which is a good thing if you're a dollar bull. You start, maybe that's this green line, the lower boundary of the trading range will start to converge a little bit. Gold still bullish from a short-term and medium-term price momentum basis, still in the middle of the range. 10-year bearish, short-term, bullish, medium-term, middle of the range. S&P 500 bullish now on both durations. That's new. And now it's in the middle of the range. Let's see, we got upside in the S&P to around 4,100. We talked about that level 4,100 in our October 29th around the horn as the target for this current bear market rally. So now we're starting to see that number reflected in some of the shorter term trading range signals here on the longbow dashboard. VIX, that is bearish on both durations and in the middle of the range. NASDAQ 100 bullish now on short term price momentum basis, neutral on the medium term basis, middle of the range. Russell 2000 also bullish on both durations like the S&P in the middle of the range. Bitcoin, Ethereum still bearish on both durations in the middle of their respective ranges. Bitcoin's got downside. Bitcoin's got upside to 20,800, downside to around 14,100. So it's a pretty wide range there. A lot of the volatility parameters have really caused that range to blow out. That's exactly what you would expect to see. Ethereum, now the range got about 1,000-ish on the downside, 1,600-ish on the upside in terms of Ethereum there. A lot of folks pointing fingers in crypto. A lot of folks not taking not taking accountability and responsibility for the trades that they put in their own portfolio. Let me remind you, everyone watching this program, everyone in the, I'm trying to speak to everybody in the world, because again, what I'm trying to do is help the community take a step forward and grow and become a better investor, become a better person. Just because someone says they like something on a free program, and again, I'm not talking about myself. I'm not, you probably know who I'm talking about by now, just judging by my Twitter rant last night. If someone says they like something, it's on you to do the additional research to determine A, whether this is something you should be putting in your portfolio, B, whether the macro cycle agrees with that person's view as it relates to the forward outlook for that security or for that asset class, and C, at the bare minimum, understand that if you make money in this, you're not going to share profits with the person who said that. So why would you be blaming the person who said that if you lose money in it? We need to be big boys and girls when it comes to investing. This is one of the hardest things to do in the world. Consistently predicting the future in a way that takes money from other people and puts it into your bank account is one of the hardest things to do in the world. If it was easy, we'd all be taking money from other people and putting it into our bank accounts. The reason it's hard is because we're all trying to do it to each other. And so you have to understand that there's all these different macro factors, Fed balance sheet, 42 macro net liquidity, all these different things that are making that game hard or easy at various points in time. And this is why we do so much research to understand all those dynamics. We're not going to get everything right, but we're certainly going to be good people, upstanding moral citizens about no matter how the game evolves. Sometimes things are going to go your way. Sometimes things are not going to go your way. But guess what? We're going to learn from our mistakes, and we're always going to get better. And so I just want to, sorry for interrupting the program, but I do want to make that point, because again, as long as you're on Team 42, as long as you're in this community, you will behave, you will be respectful. And I don't mean to talk down anybody, but you know who you are. There are certain people that like to point fingers and like to be, for lack of a better word, dicks to other people, and it's not cool. Don't be an internet bully because you lose money. It's your job to risk manage your own portfolio. Anyway, getting back to the program here. Shanghai Composite, that's got bullish short-term momentum, neutral medium-term momentum, getting towards the upper boundary of the probable range there. As I said, maybe last week, market's starting to run out of steam in terms of its willingness to price in rumors with respect to the end of zero COVID. We probably need to see something as it relates to real policy changes, which again, we do suspect are likely coming down the pike over the coming months. But again, how much of the market is willing to price that in, given the big move we've already seen off the lows in Chinese equities. And don't forget, it's not just the right tail risk associated with Chinese equities and anything that's positively correlated to China. I'm guessing a lot of tech stocks that sell things to China would do well in that environment as well. But don't forget that has a limiting feature, and that limiting feature is associated with the fact that Chinese crude oil demand is still down 19% from its peak prior to the zero COVID policy. So if they turn that demand function on in a material way, we're going to see a massive squeeze in energy prices. And perhaps they're waiting for Biden to get done leaning on the SPR in terms of actually doing that, and could create another shockwave of inflation to send through the system at some point in 2023. So keep that on your horizons, both as a right tail risk to certain China-related exposures, companies that sell things to China, et cetera, but also as a considerable left tail risk as it relates to what kind of a round of energy price inflation might do to both headline and core inflation over the medium term. And then lastly, crude oil, kind of what we're talking about here, neutral from a short-term perspective, momentum perspective, bearish from a medium-term momentum perspective. Crude oil, that's in the middle of the respective probable range there. So downside to around 84, upside to around 91 at the current juncture. And then lastly, getting to my free daily alpha tab. I made a joke last night. It wasn't really a joke. Like if you tune into free programs, then you have to expect you're going to get what you get from free programs. If it was easy for mutual funds and pension funds and hedge funds and CTAs and quants to generate alpha for free, then they wouldn't be able to charge, whatever they charge for their fees and services. The reason they are able to charge what they charge for their active management fees and services is because this is actually really hard to do, contrary to what $120 billion a month in QE fooled a lot of people into thinking. This is not, we're in a new phase of this game. And I understand that some people are frustrated about some of the mistakes that they made in their own portfolios over the last year. But guess what? It's all about the next play. Pointing fingers is not going to get your money back. What you need to do is accept and acknowledge that the game has changed and start getting better as an investor and as a person in order to climb yourself out of the hole and put yourself in a good position to start winning again on a consistent basis. And that's what we're doing. We're trying to send a positive message here that's about the future and about getting better and about actually starting to make money for those of you who got rugged, unfortunately, in crypto, or rather didn't get rugged yourselves, because again, you're responsible for your own trades. Anyway, going back to my free daily alpha tab, to my knowledge, this is the only other thing on earth that provides free daily alpha outside of Wifey Alpha's Twitter account. So sorting my Longbow dashboard, 300 ETFs here, all representing individual factor exposures across global macros, sorted by the odds tab. So nothing really materially overbought. That's the sun is jumping off the page today. Let's scroll down to see if there's anything materially oversold. Nothing really materially oversold. Saudi Arabia is bearish on both durations. It's getting towards the lower boundary of the trading range. I wouldn't be shorting, or sorry, this is maybe, sorry, I was taking that the wrong way. This is the kind of exposure that if you're worried about left tail risk, or sorry, both right and left tail risk associated with the China reopening. Right tail risk is, again, Saudi Arabia is going to be positively correlated, a rise in crude oil, but also left tail risk associated with right tail risk as it relates to crude oil, left tail risk as it relates to broader risk assets, and vice versa in terms of China. But if you want to get long something to play the China reopening thing, it's going to be things that are tethered to energy, because again, that's going to be where the biggest shock that we're going to experience from the growth, China's positive growth impulse. Again, we're not saying it's coming anytime soon. We're just saying that, hey, we see it coming down the pike at some point in the next few quarters. And again, this is one of those things that might make sense. It's basically overbought. Not really much downside to the lower boundary of the probable range there. Huge implied volatility premium. So this is exactly something you would buy. The only thing I don't like is the slope of that probable range line. What you want is at least a flat sloping line or an upwardly sloping line to be buying the dip into. This is not the greatest setup, and it's probably telling you that Chinese reopening theme, this rumors, the kind of the stuff that the market's gotten really excited about, particularly in Chinese assets over the last few weeks, is probably something that's more speculation than it is reality. So with that, it was a little bit long today, but guess what? We had a lot of positive messages that we wanted to send out, and just like I said, we just want to thank everybody for tuning in. This is a free program. You get what you get from free programs, and guess what? Even behind our paywall for 42 Macro subscribers, we don't get everything right, but guess what? We hold ourselves accountable. We allow our customers to hold us to account for the mistakes that we make, because again, we're always trying to get better and learn from our mistakes out loud. Not speaking to any specific mistakes recently. I'm really just defending friends of mine in the industry who I know to be good people. So just kind of telling some of the trolls to back off. So everyone have a great day out there. We'll catch you back here tomorrow. Cheers.